Hey everybody, welcome to this video. My name is Chris Harris, a certified financial planner, and today we're going to be talking about a subject that everybody knows and loves, and that is healthcare. More specifically, Medicare and how IRMAA surcharges can affect your financial plan. So we're going to dive through that, hopefully clear up some things, make it simple and digestible for you so that you can implement some of these things into your own financial plan. But as a disclaimer, this is for informational and educational purposes only and should not be considered investment, tax, or legal advice. Okay, so let's dive into this. So we have Medicare and IRMAA surcharges. So if you are approaching that retirement age of around 65, then you know that this is something that is coming that you are gonna, either use or you understand at least how this stuff works. So it could be knocking at your door, and if you're maybe a little bit further away, this is still good just to make sure that you're up to snuff on how this works. So let's dive in. So real quick, the first thing that I wanted to do is just go over a graph, and this graph can look a little intimidating, but just the simple, I think, message that it's demonstrating that the older that we get, the higher cost of our healthcare, right? So that's the first thing. So the older we get, the higher our spending is on healthcare. And then within this, so we have different age brackets. So if you can see, if we just take this 85 plus, so we can take 2020 through 2020, or excuse me, 2010 through 2020. And as you can see, it looks like we're trending upwards in terms of cost, right? So healthcare is getting more expensive as time goes on. So as we get older, healthcare gets more expensive, but then also each year it seems that the expenses that we're spending out and just taking care of ourselves, taking care of our health is also going up. And you've probably seen that if you've been to the doctor, you get a medical bill, things like that. It's not very fun. So it's something that we want to prepare for, that we want to plan for, and hopefully that will help us in the long term. Okay, so let's talk about Medicare. So we have Medicare, which is a government-funded healthcare program. Okay, so we enroll when we are 65. So we have a seven-month window. Okay, 3 months before our birth month and then 3 months after to enroll. Otherwise, we have a penalty associated with missing the enrollment period. However, if we're already covered by Social Security, then we don't need to enroll, okay? So we're already automatically enrolled into Part A, but we will need to still make sure we are enrolled in Part B or Part D if we want. So I would highly suggest you work with your health insurance agent or whomever that is to make sure that you have this figured out before, you kind of get in that penalty area. Okay, so we have 4 different parts to Medicare, okay? Oops. So Part A, this is the free version. So if you paid into Medicare for 10 years, then you get Part A for free, okay? So what does Part A give you? So Part A is hospital visits or stays, hospice, or skilled nursing facility, okay? And now these also have limits. So this is not long-term care. So there are parameters that you have to meet. Otherwise, then it's going to turn into a nightmare. So this is not long-term care, but there are certain restrictions on these that you do get for free. So Part B. So we have doctor's visits, we have preventative care, if my cursor will write, preventative care, and then outpatient services. Okay. So this Part B, probably we're going to use the most, right? With doctor's visits, things like that. this comes with a premium. So we have to pay a premium. That's terrible, but it says premium. Part C is Medicare Advantage. And this is an alternative to Medicare. And this is generally done through like a private insurance, and it includes vision, dental, hearing, okay, stuff like that. So we're not going to spend too much time on that one, but and then Part D is for prescriptions. Okay, prescription drugs. And this one also comes with a premium. So you have to pay for these. My cursor is going crazy. Premium. Okay. So right here you have to pay premium. Right here you have to pay premium. Okay. So how does this premium work? So this is where we get the IRMAA. And you've probably heard this one before. IRMAA surcharge. Okay. So what the heck is IRMAA? Okay. This is income related monthly adjustment amount. Okay. It's a lot going on there. So really all it is based off of your income, you're either going to pay more of a premium or you're going to pay the base premium. Okay. Just again, depending on how much income you have. So the issue then becomes if we have, say, a Roth conversion, or if we have, Social Security that we're getting, or if we sold, a property. So we say we sold and we got money, those type of things that increased the income that we're showing, that can cause a problem for these IRMAA surcharges, right? And so we want to be careful, but the kicker is that when we start, so we enroll at age 65, so they actually take your AGI for 2 years prior, okay? 2 years prior to your 65th enrollment period, 65th birthday. So that's what your premium will be based on. So you have to be careful then, because maybe you're like, oh, I'm going to do a Roth conversion, or, I've got a lot of income coming to me when I'm 63 or whatever that looks like. That could affect you in terms of your IRMAA when you start your Medicare at 65. So really important. So what are some strategies that we can do? Well, that really boils down to looking at maybe looking at Roth conversions, spreading them out, making sure we're not over those thresholds, maybe doing QCDs. So this could be timing. So time, the Roth conversions. This could be QCDs, so qualified charitable distributions for RMDs. Okay, so if you're taking RMD, so maybe you're already in the RMD age, 73, early 70s, whatever that looks like for you in your situation, and you have to take RMDs. Well, if you have big RMDs coming out, so we could use QCDs to then limit the income so you don't have IRMAA surcharges, as bad, kind of making sure we're not going to that threshold. It could be just being more methodical in terms of, again, how much income, smoothing that out. So if you're a business owner, you can smooth that out a little bit, or taking on certain projects in certain years, stuff like that. So that's something that we want to be aware of before we enroll, and then also during, right? So during our retirement years or our Medicare years, we want to make sure that if we do have these big hits, the IRMAA surcharge does get recalculated based off our taxes. So we do want to make sure that, that we can limit as much as possible. Okay. So it's one of those kind of traps that we can fall into if we're not careful. All right. So how does this play out in a real life scenario? So This is Austin accumulator and Lila accumulator. They're just dummy clients. And so as an example, just to show you how a tax report would look like. So we break the tax report down. We can see marginal tax brackets. We can see how much we can fill up to get to the next bucket. And really where this becomes powerful is as we can analyze from year to year. So if we look at scenario one, so this is just from a previous year, and then we can look at this year and say, okay, how for Austin and Lila, they are approaching that age in terms of Medicare. And so we want to just be aware of where they would lie in terms of their IRMAA surcharges. So for example, we're assuming that they're going to have an additional $20,000 in wages, and they're also going to do a Roth conversion. Okay, so there's going to be another $40,000 that will be added to their income. And so what we can do as we go down the list, we can see kind of tax liability. We can look at different withholdings and things like that, and kind of come up with a guesstimate, working with a CPA and things like that to see how this would shake out potentially for them. So what we do is we can then, and I don't want this to scare you, but this is more of a chart that can show. So we start with their baseline income. So right now it's $147,222. We take their baseline, and then in addition to their income, so if they were to add another $29,000, they would then increase their IRMAA surcharge to $1,172 per year. So you can see the dotted lines here is going to include Part B and Part D of Medicare and the annual increase associated with that bracket. Okay, so as we can see right here, they have an increase. If we were to add another, $87,000, then they would jump up in that bracket. Okay, so the IRMAA surcharge is a cliff. So if you're $1 over that number, that cliff number, that bracket, then you go to that next premium. Okay, so we can see that with ordinary income or capital gain. So the same kind of situation, we have a huge capital gain. And again, you don't need to focus on the other numbers. That's for other things that we look at. Just for the Medicare part, though, you can see the dotted lines again and how that affects the premiums for our Medicare Part B and Part D. Okay, so it's really a powerful tool to look at and to say, okay, if we can, how much can we fill our bucket up, so to speak, before our premium goes, but still take advantage of whether, like I said, a Roth conversion or things that may be advantageous, or a sell of property or whatnot. So it becomes a very powerful tool to stay below those premiums if we can help it. So kind of going back, and now what we do is we come up with a tax report again. We come back and we can say, okay, based off of where we're at, we can do the Roth conversion, add the extra income, and we're still going to be at the lowest, Part B premium, and then Part D premium as well. So we'll look at the MAGI on this. So our MAGI, or modified adjusted gross income, is just our AGI, adjusted gross income, plus our tax exempt interest. So as we look at that, then we can say, okay, well, our premium now is still, it's still in a good spot. So if we were to do that and to accomplish what we wanted to with our Roth conversion and our added income, then we're still going to be okay. So it's just a planning tool to make sure that we're not, falling into a higher premium if we can help it. Okay, and you can see the different breakdowns here in terms of our premiums versus our MAGI. Okay, so going back, so I want to show you just this last graph here, and this shows the MAGI cliff. So this is our Medicare income related, or IRMAA, amounts for Part B and D, and this is just for individual filers on an annual basis. So as you can see, these cliffs, again, you go over and then you go right to the next premium level. Okay, so it's not like a linear deal here. It's just you're cliffed, okay? So you just go right to the next one, and you get the full charge, right? You get the full premium charge if you go over that threshold. So as you can see, these surcharges add up, right? And they can become very daunting, especially from a financial planning standpoint. So we want to make sure we take this into account when we're looking at those financial plans and planning out your retirement, right? So we want to make sure if we're pulling from different portfolios or we're taking interest or cash or things like that from the portfolio, we want to make sure that we have included the the premiums for Medicare in that planning. So I hope that this helps. I hope it wasn't too overwhelming, but hopefully it made some sense, and that you can again take that and apply that to your own planning as it pertains to your Medicare. And again, that's really where you want to work with a health insurance advisor or something like that knows Medicare and all those inside and outs, and connect it with your financial plan. Just again to make sure that you're not doing something that could affect your premiums. Okay, we'll catch you on the next video. Thanks for watching.